Good morning, friends. Welcome, everyone. I think we have enough participation now to get started. I was waiting for people to join in today, especially today because it's the first class, and I don't want you to anyone to miss anything on day one. Okay, so once again, welcome, and we'll get started with first chapter straight away. But just before that, in case anyone missed the orientation session, let me quickly walk you through what we are going to cover in the FAR syllabus over the next, whatever 10, 12 weeks. So I hope you can see my screen. Can you all see my screen? You can quickly write in the chat box, yes, if you are able to see it. Am I audible? Okay, great. Great. So I'm audible to all of you. You can see the screen. So we are good to go. FAR 1, right? Normally, I refer to this as a chapter. Okay, so because there is a confusion, a lot of students get confused between chapter and module. So FAR 1 is a chapter. In this chapter, there are 4 modules. M1, M2, M3, M4. And that's how, it's not just, I say it, that's how the Becker software is also structured. When you open FAR 1, it says M1, M2, M3, M4, which means module 1, module 2, module 3, module 4. Right? So FAR 1 is one chapter which has 4 modules. And we are going to start with this, of course, today. In this, we'll cover balance sheet, income statement, comprehensive income. Now, if you're not familiar with what is comprehensive income, we will, of course, talk about it. EPS is earning per share, public company reporting topics. So here we are going to cover some SEC reporting, right? Like the annual filings that happen, quarterly filings that happen, right? What are the form numbers? What are those forms called? What are the due dates? What needs to be filed in those, along with those forms, etc. Then stockholders equity, which is your, first, so in order of permanency, when you prepare the balance sheet in order of permanency, that means the more permanent items are on the top, stockholders equity is on the top. When you're creating the balance sheet in terms of liquidity, right? In order of liquidity, then stockholders equity is at the bottom, right? Because the most liquid items are on the top. So stockholders equity, either the first item in the balance sheet or the last item in the balance sheet, depending on whether you are preparing the balance sheet in order of permanency or in order of liquidity, right? But a very, very important part of the balance sheet, right? Stockholders equity, and it's divided into 2 parts, part 1 and part 2. Now, in these two, as we will see, one of the trickiest topics which most students find is the treasury stock, right? When the company buys back its own stock, own shares, right? Which is called treasury stock here in the US. So in that, we have 2 methods, cost method and the par value method. And, the 2 methods are sort of, they are confusing, right? Most students find them confusing. Okay, so we'll cover that, and I'll take you through that slowly. We'll not rush through it. Of course, there are many topics in this stockholders equity part 1 and part 2, which we will cover, but I just wanted to draw your attention to the treasury stock part. If you are noting down somewhere, then maybe you can note that down, that this is considered to be tricky by most students. And questions are also sometimes tricky. Of course, EPS, you can note down EPS. Yeah, in this, I would say EPS and treasury stock are like the 2 tricky topics, sort of. Okay, not very tricky, but yeah. Okay, FAR 2 revenue recognition, again a tricky concept, and especially the revenue recognition part 2, which has now been brought back to FAR. Here we can only see one module on revenue recognition introduction, right? But they have brought back the revenue recognition other concepts into FAR, Earlier, they had taken those topics to FAR. Now they have brought back to FAR. Okay, so we'll cover those as well. And in that, there are multiple small topics, and they are tricky, right? Especially the forward, the call, and the put. Okay, those are considered to be tricky by many students. Accounting changes, error corrections, adjusting journal entries. Again, some people find it tricky because if your basics are not strong, then you will find adjusting journal entries tricky. So in the orientation also, I had requested everyone to just go brush up your basics, just go through your class 11th accounts book, glance through it, journal entries, the ledger posting, trial balance, stuff like that. And because, your basics have to be strong. I'm not saying do your BCom stuff or your CA stuff, CA related stuff, because then you go into specifics of Ind AS and the Indian GAAP. I don't want you to do that. I just want you to do the basics of 11th, 12th. And maybe when you do bar, some basics of costing and financial management and economics. Okay, like absolute basic stuff. Okay, what is demand, what is supply, the different market forms. You have monopoly, oligopoly, etc., monopolistic, perfect competition, pure competition, all that stuff. Absolute basic stuff, not anything specific to India, because here obviously we are going to study things which are specific to the US, right? So when it comes to FAR, just the 11th, 12th stuff as of now. If there is anything else required, I'll let you know later. So do that. Anyways, we are not going to do FAR 2 today. So you still have one more week. You can just brush up your journal entries, from class 11th. Notes to financials, subsequent events, fair value measurement. Sometimes some students find this tricky, fair value measurement. So you may note it down. Special purpose framework, ratios, not very tricky. Then FAR 3, we are going to go into the components or rather the elements of the financial statements. So cash and cash equivalents, trade receivables, inventory. In the US, they call it inventory, right? So I mean, obviously here in this exam, there is no interview, there is no viva, it's only written, so you don't have to worry about the pronunciation aspect. But later when you apply for a job to the US or to an American company, maybe anywhere else in the world also, you have to say inventory, right? And this is a big thing. I mean, don't take it very lightly, because they sort of don't understand if you don't say it the proper way, their way. So I have faced it myself. In the US, vitamins are called vitamins, right? And when I first went there, I did not know that they call it vitamins. So I went to they have specific vitamin shops in the US. Like that entire shop is like just vitamins. Okay, all sorts of vitamins, supplements, etc. So I went to this shop and I said, can I, because somebody had asked me to get something for them, and because in those times, people had to go to the US to take the exam, right? So whenever anyone went to the US, their family, relatives, friends would give them a list that please get this for me, get this for me. I also got a list when I went, right? And one of the things was this vitamin something, vitamin D, something. So I went to this shop and I said vitamin D, and they just did not understand. It was a vitamin shop, it does not take much to understand that somebody might be calling vitamin, but they just did not understand. I said it twice, I said it thrice. Vitamin D, I also said vitamin D. They did not understand. I mean, just did not understand. Then I had to point out, I had to figure out where is vitamin D, and I had to point out, I want that. And then later, I got to know, I mean, I thought to myself, why didn't they understand? And, then I figured out that they call it vitamin. And so this just simple, they did not understand vitamin. Standing in a vitamin shop, just because they call it vitamin, they just did not understand what is vitamin. So don't take it lightly is what I'm saying. Inventory, FIFO, FIFO, first in, first out is called FIFO, last in, first out is called LIFO, right? So things like that. And I'm going to use those pronunciations, wherever applicable, wherever there is a difference, so that you get used to that. Okay, in case you plan to give an interview and go for a job, or even Canada, not just US, even in Canada, the pronunciations are similar to the Americans, right? So yeah, get used to that slowly if you plan to go there. PP&E, property, plant, and equipment, which is basically fixed assets. Right, so property is the land, plant is the building, right? And equipment covers everything else. Your machinery, motor vehicles, air conditioning systems, furniture, fixture, everything else comes in the category. This is a category, and category is called category. So it comes in the equipment category. PP&E is divided into two parts: cost basis, where we'll just talk about, at what cost will you capitalize those assets. And then in the second module 5, we'll talk about the depreciation on those assets, disposal, impairment. Then we'll talk about intangibles with finite life, right? So intangible with indefinite life is basically goodwill, right? Goodwill has an indefinite life. So that is specifically not covered here. Here what they have covered is intangibles with finite life, like, copyright, trademark, patents, etc. Liabilities. Now this one focuses, FAR 3 focuses on assets, FAR 4 focuses on liabilities, right? So it is very nicely structured. You have payables and accrued liabilities here, contingencies and commitments, long-term liabilities, bonds, part 1, part 2, again considered to be tricky by many students. Bonds, troubled debt restructuring and extinguishment, and then lessee accounting. Lessee accounting considered tricky by many students. Okay. See, I'm not using the word important or not important, because everything is important. This is one exam where you should not do any, pattern kind of a thing, that this is the pattern or this is the trend. That is extremely dangerous and risky, because there is no trend, right? In the last 1 year, they may have been asking questions from a particular chapter. When you go for the exam questions, there may not be a single question from that chapter, and everything is from other chapters. So don't do any pattern thing, don't do any trend thing, don't ask around people what was asked in your exam, what questions were asked. That is, just for the sake of, gathering information, you can do that, but don't sort of make that as a threshold or a benchmark, right? You have to study each and everything from the book, cover to cover, first page to last page, and I will take you through that. But when you do your revision also, you have to do that, right? So all I'm saying here is, which are the tricky topics. Important, everything is important. Okay. Oops, sorry. FAR 5, investment statement of cash flow and income taxes, financial instruments. Luckily or unluckily, they have not gone into too much details, because financial instruments in itself can be like one full chapter or maybe one full book. It is such a tricky area, but fortunately or unfortunately, they have not covered too much. They have just, they are just on the surface, not gone into the depths of the topic at all, right? So good thing for you from an exam point of view, that it's very simple, right? It's not as tricky as, let's say, your CA exams or CFA exams, right? Where financial instruments is like a very heavy area, right? Here it is not a very heavy area, it's a very light area. Then equity method of accounting, consolidated financials, right? For partnership again is not as detailed as what you had in your class 12th. In class 12th, there was an entire book on partnership. If you are from CBSE, right? In fact, even from ICSE, I think there's an entire book on partnership, right? Where you have separate chapters, one on the fundamentals of partnership, then one on just on profit sharing ratio, change in profit sharing ratio. There's a separate chapter. There's a separate chapter on goodwill and its treatment, its valuation. Then you have admission, retirement, death, dissolution, right? A whole book dedicated to partnership. Here you can see from page 47 to 57, that's all. In 9 pages, partnership is done. So 9 or 10 pages, whatever. Partnership is done. Statement of cash flow. Statement of cash flow, again, considered to be tricky by some students. Consolidation, module 3 here, consolidated financials, considered to be tricky by some students. Income taxes considered to be tricky by most students. Income taxes here, obviously, we are not talking about income tax as such, because that is part of your regulation course, the US tax, the Internal Revenue Code. Here we are talking about the treatment, the accounting treatment of income tax in the GAAP financial statements. What is going to be the accounting treatment for income taxes in your GAAP financial statements? Here we are not going to talk about, the salary income and, the house property income and stuff like that. That you are going to learn from in your regulations. Okay. And then finally, you have FAR 6, which is not-for-profit accounting and governmental accounting. NFP is simple. I mean, considered to be simple, but governmental accounting is something that a lot of students find it very tricky. Okay, so I think I have told you which are the topics which are considered to be tricky by students. Not necessary that you will find them tricky, maybe you will find them easy. I'm just saying that a lot of students find these topics tricky. And so I'm going to go slow, when we reach these topics. Okay. All right, guys. So I think by now, everyone who wanted to join must have joined. So let's get started. So I'm shifting to FAR 1 here. Can you see my FAR 1 page? Yes, you can. And if anybody is facing an issue, I think it could be at their end. Maybe your network is not, up to speed or something, because everyone else can hear me and see my page. So maybe you have to check your network. And if everyone is facing an issue, then it's a problem at my end. Right. So before I start, let me quickly once again confirm, can you all hear me? Yes. And can you all see my screen? Yes. Okay, great. So maybe, Ashish, you have to check your network. Yes, I'll reset the page. Wait. Better? All right. So as we saw, okay, sorry, just give me 1 second. Just give me one moment, please. I'm because my pen is supposed to work on that sheet. Otherwise, I won't be able to write anything. All right. So I'm now sharing the screen again. Okay. So sorry about this. Quickly again, can you see this screen which I've shared now? Yes. Yes, right? Okay. Okay. So let's get started now. So as we saw, we will start with balance sheet, income statement and comprehensive income. That is module number 1. These are modules, right? So module 1 is your balance sheet, income statement, comprehensive income. And the name of the chapter is financial reporting. I mean, this is FAR 1, right? FAR 1, financial reporting. There's no as such other name to this, right? It's just FAR 1, financial reporting. Okay, so module 1, balance sheet, income statement, comprehensive income. And this is, of course, very, very simple. You are all familiar with the balance sheet. Under US GAAP, general purpose financial reporting. Now, first of all, let us talk about this. First of all, of course, we are covering US GAAP in your syllabus. There is no IFRS, right? Earlier there used to be, but now it is not there. IFRS is not part of your syllabus anymore, only US GAAP, only and only US GAAP. So in the exam, if the question does not specify anything, obviously it is asking about, I mean, it's a US GAAP question. What will be the treatment of this item if it says, it obviously means what will be the treatment under US GAAP, right? So your syllabus is only US GAAP. General purpose financial reporting. So US GAAP is a general purpose financial reporting framework. US GAAP is a general purpose financial reporting framework. Okay. So general purpose financial reporting framework, IFRS is a general purpose financial reporting framework. US GAAP is a general purpose financial reporting framework. Similarly, you know, UK GAAP, German GAAP, Canadian GAAP, Indian GAAP, Russian GAAP, French GAAP. These are general purpose financial reporting frameworks. So what is the other thing? The other thing is special purpose financial reporting frameworks. And special purpose financial reporting frameworks we will cover later. There is a separate module. Special purpose, pardon my handwriting, you know, on the digital pad, you know, it comes across like this. As long as you can understand what I'm writing, I guess it's okay. So special purpose special purpose framework are cash basis of accounting, regulatory basis of accounting. In the US, they call it regulatory basis of accounting, right? Then you have, you know, income tax basis of accounting, contractual basis of accounting. So we'll talk about those when we reach that module. These are special purpose framework, income tax basis of accounting, right? So these are called special purpose framework. US GAAP is a general purpose framework. Ind AS, right? Indian GAAP is a general purpose framework. IFRS is a general purpose framework, and so on. And of course, US GAAP, which is a general purpose framework, is on accrual basis. Right? Is defined as a full set of financial statements. Now let's stop here. What is a full set of financials? Right? And as you can see here, the bullet points: statement of financial position, statement of earnings, statement of comprehensive income, statement of cash flow, statement of owner's equity. This is considered as the full set, right? So you have 1, 2, 3, 4, and 5 statements plus the notes. Notes are always considered to be an integral part of the financial statements. Notes are always an integral part, whether it is mentioned or not mentioned. Without the notes, the financials are incomplete, right? So, and notes is written over here. Okay, so under US GAAP, general purpose financial reporting is defined as full set of financial statements. That means all these 5, wherever applicable. If, let's say, statement, we'll talk about it later. If a particular statement is not applicable to you, then obviously you will not prepare it. But if it is applicable, then you prepare all the 5, and that is considered to be the full set of the financial statements. And of course, notes, which are always an integral part of the financial statements. A full set of financials typically includes these 5, right? And why are they called? See, first of all, it is plural here, statements. It is not one single statement. There are 5 of them. That's why it's plural, financial statements. And by the way, these are statements, right? So you can see the name also suggests it's a statement of financial position, statement of earnings, statement of comprehensive income, statement of cash flows, and statement of owner's equity, right? So that is why they are called financial statements. These are not accounts as such, right? Statement of earnings, income statement is not an account. It is a statement. Okay. Now, statement of financial position is the balance sheet. Statement of earnings is the income statement, right? In the US, they call it the income statement, not P&L. It is called the income statement. Statement of comprehensive income, we will talk about it. Then statement of cash flows, there's a separate module on this. And then statement of owner's equity. And by the way, this is statement of changes in owner's equity. Statement of changes in owner's equity. So not just the statement of owner's equity. Now, what is the difference? Difference is if I just give you the statement of owner's equity, that means I'm telling you on December 31, and by the way, in the US, normally calendar year is the financial year. Normally, I'm saying normally because you have a choice, right? You have a choice. You can follow any year as your fiscal year. You can follow Jan to December. You can follow April to March. You can follow July to June. You can follow October to September. You can follow any year as your financial year. There is no mandate that you have to follow this, right? Like in India, you have April to March as the financial year, right? For companies. In the US, even companies still have a choice, right? India also has had a choice up until Companies Act 1956 was there. Then Companies Act 2013 has made it mandatory to follow the April to March year, right? Of course, exceptions are there, but that's the general rule in India, right? For companies under Companies Act 2013. Now, I have myself told you that we are not going to compare India with US, so I'm not going to do that any further. This was just to help explain that in the US, right, you follow normally, you have a choice, you can follow any year, but most companies and most other entities also follow January to December as their financial year. So if I give you the statement of owner's equity, that means I am telling you, okay, on December 31, let's say 2023, this was my owner's equity. Like I had this much of common stock, I had this much of APIC, APIC, I had this much of retained earnings. This will be called, statement of owner's equity. But we have to present the statement of changes in owner's equity. That means we have to show the entire movement, that this was my beginning balance. That this was my beginning balance, January 1, this was my common stock, this was my APIC, this was my retained earnings, right? Whatever amount. Then during the year, this happened. We issued stock, right? Issued shares. So my common stock had a plus or a minus, right? A plus or a minus, issued or bought back. Similarly, retained earnings, my net income will get added here. Retained earnings, net income or net loss will get added or subtracted. Similarly, if there is any issue of stock at a premium, the premium portion will go to the additional paid-in capital, APIC. This is called APIC, additional paid-in capital. We will talk about all these items later. So whether there is a plus or minus over here, any movement over here, and then December 31 balance, right? So this would be called a statement of changes in owner's equity. This is not just statement of owner's equity. This is a statement of changes in owner's equity because we are also showing the movement here, the plus and minus, what movement happened during the year. And if it was statement of owner's equity only, then we would have to show only this column. Right? So this is actually statement of changes in owner's equity, okay, which you have to present. You have to present as in companies have to present in their full set of financials. Okay, so is that clear, everyone? So far, everything good? Okay, so US GAAP is a general purpose financial reporting framework. Its full set consists of these 5 statements plus the notes, right? And these are statements, not accounts. That's why they are called statements, right? Okay, so entities may present a classified balance sheet. Classified balance sheet means that distinguishes current and non-current assets and liabilities. When appropriate, a balance sheet presentation based on liquidity is also permissible. That means in order of permanency as well as in order of liquidity, both are permissible. Following is an example of classified balance sheet. Classified is one that distinguishes between current items and non-current items, right? So balance sheet as of December 31, year 1, as of is also fine, as at is also fine. As at is also fine, right? Both are considered okay. So as of December 31, year 1. Now, very, very important thing that you can notice here, assets are on the left, liabilities are on the right. Assets are on the left, liabilities and stockholders' equity is on the right. Now you must be wondering, why is this? Just like, they drive the cars on the other side, right? There's a left-hand drive. We in India do a right-hand drive. Similarly, the balance sheet is also in the opposite. We show the assets on the right and liabilities on the left. They show the assets on the left, liabilities on the right. And by the way, if I tell you the logic here, then there will be a complete probably shift in your thinking. All these years you have been thinking that liability should be on the left and assets on the right, and that is the right way of showing the balance sheet. Let me tell you the logic over here. The logic over here is assets. When you prepare a T account, you always write debit on the left and credit on the right. Always, regardless of the account, whether it is an asset account, a liability account, an equity account, a revenue account, or an expense account. When you prepare a T account, debit is always on the left and credit is always on the right, isn't it? Now, assets have a debit balance. Assets have a natural debit balance, isn't it? So, assets should be written on the left. And that is what they are doing. Assets are written on the left because normally in a T account, obviously balance sheet does not have a debit credit side as such. But if it was a T account, then the debit side would be this and credit side would be this. And assets have a natural debit balance. So assets are written on the left side and liabilities and stockholders equity have a natural credit balance. And so they are written on the right side. Makes more sense, isn't it? Assets have a debit balance, so they are written on the left because in the T account also, debit is always on the left. So like I said in the orientation also, there would be differences in treatments, there would be differences in presentation. You may agree with it, you may not agree with it, but that's what US GAAP is, and you will have to learn that and answer questions based on that. We will not get into a debate with each other, that which one is better. There is nothing called which one is better. It is a different presentation. We have a different presentation. That's all. It's different. That's all. There's nothing better or worse. Both are good, right? Right. So in the US, assets are presented on the left, liabilities on the right. And this is a classified balance sheet and it is in order of liquidity. It is in order of liquidity. So the most liquid item is on the top. Cash is the most liquid item on the top. And then you go, in that particular order of liquidity, trading securities at fair value. Okay, trading securities are shown at fair value. So we will see that in the balance sheet, different items are shown at, at different measurement basis. Trading securities measurement basis is fair value. Accounts receivable is net realizable value, NRV. Note receivable. So different items at different measurement basis. And when we go to their respective modules, we will talk about the measurement basis. Okay, here it is written, so I highlighted. Accounts receivable, net of allowance, right? Then you have notes receivable, inventory, prepaid expenses. These are your current assets. Then you have investments, available for sale securities at fair value, held to maturity securities, investment in affiliates, right? So these are all your investments. And so I'm covering the asset side first. And you have property, plant and equipment. Sorry. Property, plant and equipment. Like I said, property, land is property, building is plant, everything else falls in equipment category. Equipment, less accumulated depreciation. So accumulated depreciation is a contra asset. It's called a contra asset. It's a contra asset. It is reducing the asset balance, right? So if the asset is 100 and accumulated depreciation is 40, then your net amount is 60, right? So this is actually reducing your balance from 100 to 60, right? Right? You all are aware of that. So it is called a contra asset. Accumulated depreciation is a contra asset. And of course, all your property, plant and equipment items are subject to depreciation except land. land is not a depreciable asset. Right? Then you have intangibles. In intangibles, you have goodwill. I mean, this is just an illustrative balance sheet. It is not an exhaustive list of items. So in this balance sheet, they have shown goodwill. Goodwill is an intangible item. Patents, net of amortization. Now, why is net of amortization not written against goodwill? Because goodwill under US GAAP is not amortized. Goodwill is tested for impairment. Okay. Goodwill is tested for impairment. And of course, if there is impairment in the test for impairment, if we find that there is impairment of goodwill, then its value will be brought down. Right? So its value goes down because of impairment. It is not amortized under US GAAP. Other assets, pension and other post-retirement benefits, deferred income tax asset. So as you can see here, of course, pension is not part of your syllabus anymore. It used to be, and it used to be a very tricky topic. So luckily for you guys, pension is not in your syllabus anymore, but deferred tax is. So deferred tax asset is in the non-current section, right? So deferred tax, regardless of what gave rise to it, is always considered as a non-current item. Okay, regardless of what gave birth to it or what gave rise to it, it is always considered as non-current. So that's your asset side, right? Current assets, investments, property, plant and equipment, intangibles, and then other. And then other, okay? 5 main headings. Then on the liability side, we have current liabilities. Current liability. Now, important thing here, current portion of long-term debt is considered current liability under US GAAP. Current portion of long-term debt. That means, let's say you have a 10-year loan, you are repaying $1 million loan, you are repaying 100,000 every year. Example, very simple example. Of course, we will go into details later. You have a $1 million loan, you are repaying 100,000 every year. You are going to do that for the next 10 years, right? 100,000 plus interest. The principal amount is $1 million, right, of loan. And also, guys, we are not going to use the lakh format. We are not going to use the, so 1 lakh. This is 1 lakh, right? In the US, it is $100,000. In the US, it is 100,000. There is no lakh. It is 100,000. Okay, so we are not going to use this. We are going to use this. Similarly, this is not 10 lakhs. This is 1 million. Right? This is not 10 lakhs. This is $1 million. So you have to get used to this pattern also. All right. So suppose it was a $1 million loan. And now you are paying 100,000 every year for the next 10 years, plus interest. So whatever is due within the next financial year, next 12 months, or the operating cycle of the company, whichever is longer. What is the definition of current? It is not 12 months. It is 12 months or the operating cycle of the company, whichever is longer. Right? So if the operating cycle of a company is 15 months, then it is 15 months. Whatever is due within the next 15 months is current. If the operating cycle of a company is 9 months, then it is 12 months. Whichever is longer, that will be considered as current. Okay. Now, what is operating cycle? that we will talk about when we do the ratios module, right? The operating cycle of the company. Okay, we will talk about it when we do ratios module. So the 12 months or operating cycle, whichever is longer, is current. Let's consider 12 only here. Okay, just for this example, let's consider 12 months as current. So whatever is due within the next 12 months will come, although it's a 10-year loan, this $1 million loan, it's a 10-year loan. But this portion is due within the next 1 year, next 12 months. So it is going to be shown here in the current liabilities section, right? So US GAAP treats the current portion of long-term debt as current. Small things that you need to remember. If you show the whole thing under non-current, your answer is going to be wrong. Okay, then we have accounts payable, notes payable, interest payable, salaries payable, unearned revenue. Unearned revenue is basically your income received in advance. That is your unearned revenue. You have not earned it yet, right? And okay, what is the difference between accounts payable and notes payable? Anybody? What is the difference between accounts payable and notes payable? Come on, guys. It's very basic. You don't know? If you don't know, then just write IDK. IDK, I don't know. At least, so that I know whether you are still thinking about the answer or, or you don't know. All right. All right. Okay, fine. No, if you don't know, no problem. And those of you who have answered are, it's not like the precise answer. You're partially right, but it's not the correct answer. Okay, no problem. We'll talk about it. As we saw, there's a separate entire chapter on liabilities. We'll talk about it over there. Okay, but yeah, let me quickly tell you, you have accounts receivable here, notes receivable. You have accounts payable, notes payable. What is the basic difference? What is the basic difference between the two? This is verbal, this is written. Accounts receivable is verbal, and this is in writing. Note is in writing. A note is a promissory note or a bill of exchange. You must have heard of these terms. Promissory note or a bill of exchange. That is a note, right? So receivable or payable, whatever, it is in writing. And AR is your normal. You have sold goods to someone on credit. That party becomes your AR, accounts receivable, right? It is verbal. Of course, verbal here does not mean that the whole entire transaction is verbal. Entire transaction could also be verbal, right? The entire transaction could also be verbal, but there could be some documentation like the invoice. So there would be the invoice, but still it is considered verbal because the AR party has not given anything to you in writing in the form of a promissory note or a bill of exchange. Of course, you have given them goods, you have sent the invoice to them. They may have also signed the invoice and given a copy back to you, but still it will be considered under AR. Note receivable is when specifically they give you a promissory note or a bill of exchange. And then then the AR becomes NR. Right? And of course, we will talk about it in detail, but very quickly, let me show you the difference here. Just give me 1 second. Another thing, is in the US, we write journal entries like this: debit AR, credit sale. Debit AR, credit sale, right? Now, I know I have asked you to go through the class 11th, book to brush up your basics. When you sell something on credit, when you sell something to someone on credit, right? For example, sold goods to XYZ, right? I'm talking about class 11th. In your class 11th book, when you see something like this, sold goods to XYZ, rupees 10,000. And you see the answer to this, it would be XYZ account debit, XYZ account debit to sales. This would be the entry that you will find over there. Right? But in the US, in the exam, in the CPA exam, if sold goods to XYZ is written $10,000, the entry would be debit AR credit sale. Okay, debit AR credit sale $10,000. So first of all, it is not written like this, right? Format. The format is not like this. The format is this. Debit AR credit sale. And of course, here it is XYZ account debit to sales, and here it is debit AR. Right? And of course, that is only for the purpose of CPA exams, not in practical life, right? In practical life, when you do entries, like if you are working for an American company and you are doing entries, of course, nowadays everything is done by the softwares. But yeah, practically XYZ, a separate, account would be maintained for XYZ, and then at the end of the month, all the AR parties, basically AR is a balance sheet item, right? In the accounts, you will maintain accounts for XYZ, right? And that is where the day book concept comes into picture, right? You have a sales day book, you have a purchase day book, you have you have a sub ledger for your receivables, payables, etc., etc. So yeah, so I was discussing about this AR/NR thing. So when you do your first entry, it is debit AR credit sale. And now suppose this AR party gives you a promissory note. So then your AR party, you will not, close it down by crediting it, and you will have a note receivable as an asset in your balance sheet. Because now you have got a promissory note or a bill of exchange from this AR party that I promise to pay you on so and so date, right? So first entry is debit AR credit sale. When they give you a promissory note, it becomes debit NR credit AR, right? And that is the basic difference. Then long-term liabilities, bonds payable, deferred tax. As we saw, deferred tax is always considered under non-current. If it's a deferred tax asset, then obviously it will be on the asset side. If it's a liability, it will be on the liability side. But wherever it is, it will be in the non-current section. Then pension and other post retirement benefit liabilities, right? So pension is also something where you can have an asset or you can have a liability. This topic is not there anymore in your syllabus, but just to give you an idea, you have pension assets. So the fair value of the pension assets, and you have the pension benefit obligation. So if the fair value of the pension asset is more than the obligation, then you have a net asset. And so you will show it on the asset side. But if the PBO is more, pension benefit obligation is more than the fair value of the net assets of the pension assets, then it is a net liability situation. Your liability is more than your asset. So then it will come in the liability, right? So depending on whether your assets are more or your obligation is more, it could be on either side of the balance sheet, depending on which one is more. Similarly, for deferred tax, you have some deferred tax asset items, you have some deferred tax liability items. If your asset items are more than liabilities, then you have a net asset position. If your DTLs are more than DTAs, then it's a net liability position. Correct? So depending on that, it will appear on the appropriate side of the balance sheet. That's why you see these two items on both the sides. Obviously, it will not appear on both the sides in a particular balance sheet. It will appear on any one side. You will not have a situation where you have DTA also on the asset side and DTL also on the liability side. No, never. That's a wrong presentation. You will have to net it, and the net amount, if it's an asset, will go to the asset side. If the net amount is a liability, it will go to the liability side. Okay, so that was your liabilities. Now you have stockholders' equity. In this, you have capital stock. This is called APIC, additional paid in capital. Paid in capital in excess of par. In excess of par. Because it is in excess of par, basically it's the premium amount, in simple words. Of course, we will see the details later. Because it is in excess of par, it is the additional amount. It is called APIC, additional paid in capital. So you have common stock, additional paid in capital, retained earnings. Then you have AOCI, accumulated OCI, other comprehensive income. We will talk about it in detail also later. You can see here treasury stock at cost. Okay, so treasury stock is a minus item. It's a minus item. Okay, the shares that you have issued is a plus item. The shares that you have issued is a plus item, right? These are the shares that are issued, outstanding, etc. Right? Outstanding. So it's a plus item. When you buy back your shares, it's a minus item. Right? So it's a contra equity. Treasury stock is a contra equity item. Just like we saw accumulated depreciation is a contra asset item, treasury stock is a contra equity item. Now, when you reduce treasury stock at the end, at the bottom of stockholders equity section, this is the cost method. That means here, I'm giving you a tip on, let's say, an interview question. In the interview, they ask you, how do you determine from the face of the balance sheet which method they have applied? And your answer, if you know this, right, your answer is this is cost method. When treasury stock has been deducted at the end, it is cost method. In the par value method, what happens is it is deducted right here in the less treasury stock. So if a company has done less treasury stock over here, that means they are following the par value method. If a company has done a treasury stock at the end over here, then they are following the cost method. Okay, so the interviewer has just shown you this page and they are saying, tell me which method they have followed, right? And you know the answer. Similarly, just by showing this balance sheet, if I simply ask you a yes/no question, okay, yes/no question, is it a balance sheet prepared under US GAAP or is it a balance sheet prepared under IFRS? Right? Is it okay? So yes, no. Is it a balance sheet prepared under IFRS? Of course, now you know, because obviously it is in the Becker book, it is in the CPA book. So you know that this is a US GAAP balance sheet. But if I asked you a question, like if I was the interviewer and if I asked you that is this balance sheet an IFRS balance sheet, and you would see and you would say no. On what basis would you say no? Because in IFRS, there is a concept of revaluation, right? In US GAAP, there is no concept of revaluation. So in the IFRS financial statements, you have something called revaluation surplus or a revaluation loss, right? So just by looking at that, whether there is a revaluation surplus or loss appearing in the income statement anywhere, you will know whether it is a IFRS, not by the balance sheet, income statement. You will know whether it is a IFRS financial or US GAAP financials, right? And of course, also the order here, of course, assets are on the left, liabilities are on the right, etc. Right? I'm not going to go into differences between US GAAP and IFRS because that's not part of your syllabus. But I'm just giving you some, food for thought that, along with the preparation for the CPA exam, you're also kind of preparing for your next upcoming interview in a US company, right? So I hope now you're, more or less familiar with the balance sheet here, right? And this is called CAR, common stock APIC retained earnings. This is called CAR. So you always have a CAR in your balance sheet. Okay, and AOCI is accumulated OCI. We'll talk about it when we go to comprehensive income. Okay, so now let's move to income statement. Uses of the income statement and terminology. Purpose of income statement is to provide information about the uses of funds in the income process, that is the expenses. The uses of funds that will never be used to earn income, that is losses. Now see, very important line. The funds that have been used in the income generating process, income generation process or income generating process. Funds that you have used to generate income are your expenses. Funds that have been used but they will never generate any income, use of funds that will never be used to earn income, are your losses. So US GAAP treats expenses and losses separately, right? Expenses are separate from losses, and similarly revenues are separate from gains. Sources of funds created by those expenses are revenues. The sources of funds created by those expenses, the expenses that you incurred in generating revenue, right? So there is a linkage between revenue and expense, right? A matching. You are matching, there's a matching concept, right? You have incurred an expense to generate a revenue. This revenue has been created by these expenses, right? So it is in the context of each other. Use of funds in income process, source of funds created by those expenses, right? So there is a matching over here. And the gain is the source of funds not associated with the earning process, right? Source of fund not associated with the earning process again. So your earning process, that means earning process, when we use the word earning process, that means we are basically referring to your core operations. What is your core operation? So if you are a pen manufacturing company, then manufacturing and selling of pens is your core operation. If you are a shoe manufacturing company, then manufacturing and selling of shoe is your core operations. Now, see, if you are a pen manufacturing company, then manufacturing and selling of pen is your core operation. When you sell a pen, you are going to show it as revenue. But if you, let's say if you sell a table, which is a piece of furniture, and there is a gain on the sale of that table, you are going to show it under gains. Or if there is a loss on the sale of that table, you sold this table also, you sell this table, and there is a gain or a loss, it will come under gain or loss, right? This gain here or the loss over here, it will not come under revenue. But if you are a furniture manufacturing company, right, and you sold a table, this will come under revenue, because for you, this is your core operation. Manufacturing and selling of furniture is your core operations. So don't go by the item. Okay, a company may have sold a machinery. Don't go by the item. That machinery, that means it is part of property, plant and equipment. That means, no, if it's a machinery manufacturing company, then it is not property, plant and equipment for them. If it's a machine manufacturing company, for them machinery is inventory. For them machinery is inventory, and when you sell inventory, it is revenue for you. But if you are not a machine manufacturing company and you sell a machine, then it is property, plant and equipment, and selling of property, plant and equipment comes under gains and losses in the income statement. If there is a gain or loss on the sale of the machinery, right, then it will come in the gain or the loss part, not in the revenue or expense part. Is that clear? So don't worry, I will write it here again one more time. For a pen manufacturing company, pen is inventory and furniture is PP&E. For a furniture manufacturing company, furniture is inventory. And of course, there are other than furniture, PP&E, other assets, other fixed assets are PP&E. Right? I hope you knew this already, but in case you did not know this, then this is what it is. So US GAAP treats revenues and gains separately and expenses and losses separately. Okay. Uses of income statement. Income statement is useful in determining the profitability, value for investment purpose, and credit worthiness. Income statement is also useful in predicting information about future cash flows based on past performance. This is a general paragraph. Okay, now costs and unexpired cost. Cost and unexpired cost. So let's look at the table first, then I will come to the definition part. You see here, unexpired cost is an asset. Inventory is an asset in your balance sheet. But when you sell that inventory, you show the cost of goods sold in the it's an expense. Cost of goods sold is an expense in the income statement. So when you sell inventory, you do debit AR credit sale. Debit AR credit sale. But along with this, you also do another entry, which is debit cost of goods sold, credit inventory. You will do two entries, debit AR credit sale and debit cost of goods sold, credit inventory. Suppose you have sold goods of $100 at $120. Okay, the inventory was $100 in your books. You have sold it for $120. So your debit AR credit sale will be for 120, but debit cost of goods sold, credit inventory will be with 100. Okay, so notice one thing, that we never pass an entry for the profit. We never pass an entry for the profit. Profit automatically, or here, let me not call it profit, it's a gross profit or gross margin. We never pass an entry for gross profit or gross margin. Gross profit automatically gets captured by the system. Because on one hand, you are showing revenue at 120, on the other hand, you are showing cost of goods sold at 100. So the difference between these two, gross profit or gross margin, has already been captured by the system. There's no separate entry for gross margin. Anyway, that's a different discussion. Right now, what we are discussing is inventory was part of your balance sheet. It was an asset. It was part of your balance sheet. It was an unexpired cost. The moment you sold it, you earned revenue, but this unexpired cost became expired cost. Right? Similarly, when you have fixed assets, the net book value of the fixed assets is unexpired cost, and depreciation on that fixed asset is an expired cost. Okay, it is okay. This may sound very harsh, the example that I'm going to give. Excuse me. It may sound very harsh, right? But suppose if somebody has a 100-year life and has already lived 30 years of their life, that means 30 years have expired. The unexpired life is 70. So out of the total unexpired life, when the person was born, the person had unexpired life of 100 years. Out of that, 30 years have already expired. And now, so remaining unexpired life is 70. Right? I know it is sounding very harsh. I'm talking about a human being here. But I've taken 100 years, so don't worry. Right? It is not so harsh. Okay. So similarly here, if an asset has a 10-year life and it has been depreciated for 4 years, right? So 10 years was its unexpired life at the beginning. Out of that, 4 years have expired. So now it has a remaining life of 6 years, which is unexpired. So that is how, and eventually at the end of the 10th year, its unexpired will be 0. Everything will become expired. So unexpired will become expired by the end of it. Similarly, at the end of 100 years, when the person has lived 100 years, the person will be left with 0 unexpired. Right? Right? So expiry, I mean, now this will sound harsh. This will sound harsh. Expiry is not something that happens only once. Expiry happens every year, every month, every day, every hour. With every passing time, we are expiring. And the remaining is the unexpired. This will sound harsh, but that is the fact of life. That is the truth. We are expiring every moment. And at the end of 100 years, the unexpired portion will be 0. Right? Similarly here, expiry is happening every moment. Yes, in the case of inventory, expiry is happening in one go, like sudden. You have the inventory, next moment you don't have the inventory because you have sold it. So here expiry is sudden. It's like an accident. But here net book value going into the income statement as depreciation is a constant gradual process. It's a constant and gradual process. Every month it is depreciating. Right? So that is the difference. But eventually it will go into the income statement. From the balance sheet, it will go to the income statement. From the balance sheet, it will go to the income statement. Similarly, for insurance, prepaid insurance, it will go to the income statement as insurance expense. For patents, from the balance sheet, it will go to the income statement as amortization. So fixed assets will go into the income statement as depreciation. Intangibles will go into the income statement as amortization. And this is not an exhaustive list. There could be other items, for example, natural wasting assets like oil mine, coal mine. Natural wasting assets will go into the income statement as depletion expense, right? Inventory will go into the income statement as cost of goods sold. Prepaid will go as an expense. Fixed assets will go to the income statement as depreciation. So initially you had in the balance sheet asset side, you had an asset of $100. Over a period of time, this will become 0 and the entire thing would have gone into the income statement, but of different years. In year 1, maybe $10 will go into the income statement as depreciation. In year 2, again $10 will go into the income statement as depreciation, and so on and so forth. Eventually, the whole asset will go into the income statement as depreciation. right? So from the asset to the income statement is the route or the path that they will take. All right. I'll take your question. If you have any questions, you can post it in the chat box. I'll take it in one go. Otherwise, it breaks the flow. Okay, so now this is also another important concept here, the gross concept and the net concept. Now here, when we say gross and net, we are not talking about tax, not gross of tax, net of tax. We are not talking about tax here. This is a general gross and net concept. Revenues are shown at gross amounts, expenses are shown at gross amounts, whereas gains are shown at net amount, losses are shown at net amount. What does this mean? What this means is that, suppose I have inventory of $100. I sold it for $120. When I prepare the income statement, suppose I prepare the income statement, I will show my revenue, my sale at 120 here, and I will show my cost of goods sold at 100 here. And therefore my gross margin will be 20. Gross profit or gross margin will be 20, right? Remember your trading and profit and loss account from class 11th, trading and profit and loss account, right? And then this gross margin used to go to the income statement, to the P&L here, right? We would close the trading account here at 120. This gross margin would go to the P&L, and then we would write our other expenses, and then the net profit will arrive. This is how we used to prepare, right? So sale is shown at gross amount of 120. Cost of goods sold is shown at gross amount of 100. The profit is $20. So revenues and expenses are shown at gross. 120 is the gross amount, 100 is the gross amount. The net amount is the gross margin. That is although we are calling it gross margin, actually this is the net amount, net of cost of goods sold. So this is the sale net of cost of goods sold. Sale net of cost of goods sold is $20. Isn't it? So we don't show the net amount, we show the gross amounts. In the income statement, we will show the sale, we will show the cost of goods sold. That is why it falls in the gross concept. What is the net concept? Net concept is, if I have a furniture, if I have a piece of furniture at $100, I sold it for $120, and furniture is not inventory for me. Inventory is, suppose, pen. Pen is inventory for me, and I'm selling furniture. So furniture is property, plant, and equipment for me. So I'm selling this furniture for $120. In my income statement, I'm going to show straight away gain on sale of furniture, $20. Gain on sale of furniture, $20. I'm not going to show 120 separately, 100 separately. I'm going to show straight away $20 gain on sale of furniture in the income statement. So that is why gains and losses fall under the net concept. Revenues and expenses fall under the gross concept. Is that clear? And that is why also it is important for you to know, when you have sold furniture, is it inventory for you or is it property, plant, and equipment for you? If it is inventory for you, then you will show it at the gross amounts. You will show the revenue, you will show the cost of goods sold. But if furniture is not inventory for you, it is property, plant, and equipment for you, then you will show straight away the gain or the loss amount under the net concept. Okay, clear? So revenues are reported in gross amount of consideration to which the entity expects to be entitled in exchange for the specified good or service transferred. So it's the gross amount. Expenses, costs that benefit only the current period or the allocation of the unexpired cost to the current period for the benefit received are reported at their gross amount again. Net amount is proceeds less net book value. The furniture example that I gave, the proceed was 120. I sold it for 120, so the proceed was 120. Net book value was 100. But I'm going to show it at net amount of 20. I'm not going to show 120. I'm not going to show 100 in the income statement. I'm going to show 20 in the income statement. So gains are reported at their net amounts. Right? Gains are reported at their net amounts. A gain is recognition of an asset either not in the ordinary course of business, that is gain on the sale of a fixed asset, or without the incurrence of an expense like finding gold on the company's property. Both are gains. Losses are also reported at their net amounts, which is proceed less net book value. But if the proceed is less than the net book value, then it's a loss. If the proceed is more than the net book value, it's a gain. Loss is cost expiration, either not in the ordinary course of business, like loss on sale of investment assets, or without the generation of revenue, like abandonment. Note, items of income or loss that are unusual or infrequent or both should be reported separately as part of income from continuing operations. Nature of the item and the financial statement effect should be disclosed on the face of the income statement or in the footnotes. Now, what does this mean? So let me quickly show you how the income statement looks like. Right, of course, I'm showing you the vertical form. So I hope you understand the difference between vertical and horizontal. This on the left that I'm making like a T account, the shape of the letter T is the horizontal format. This is the horizontal format where you have revenues and expenses side by side. You have revenues here, right? And expenses here. So you have side by side. That's why it's called horizontal. Vertical is you have revenues less expenses, one below the other, vertical, right? So it's a vertical format, and the left hand side is the horizontal format, right? So in the vertical format, your income statement is divided into two main parts. The upper part is the income from continuing operations, income from continuing operations, and the lower part is the discontinued operations, right? Income or loss from discontinued operations, income or loss from discontinued operations. Now, what are discontinued operations? We will talk about it later. But right now, you just need to know that income statement is divided into two parts, continuing and discontinued. And there are two formats of the income statement. One is called a multi-step income statement, a multi-step income statement, and the other one is a single-step income statement. We will see the format of both of them in just a moment. Multi-step and single-step income statement. So here in this last para, what they said was, if there is any item which is unusual, if there is any item which is infrequent, or both, it is unusual as well as it is infrequent. Example, suppose there was a tornado in your factory. Suppose your factory is situated in Seattle. Your factory is situated in Seattle, and there was a tornado, and this tornado damaged your factory. It completely damaged your factory. So there were huge losses. Where will this loss be reported? Reported separately as part of income from continuing operations. That means it will be in the upper part of the income statement, not the lower part. It will be in the upper part in the income from continuing, but separately. We will show it separately means as a separate line item. As a separate line item, it will appear, but in the continuing operations section. Because it is an unusual thing that has happened. It is unusual. Okay. And also it is infrequent. Suppose your factory is situated in Florida and a tornado happened and it damaged your factory. This is frequent because tornadoes are frequent in Florida. So this is unusual, but it is frequent. But if the tornado happened in Seattle, it is both unusual and infrequent. It is both. Now, whether it is unusual, just unusual, whether it is just infrequent, or whether it is both, doesn't matter. Doesn't matter. Whether it is unusual, whether it is infrequent, whether it is both, doesn't matter. It will go to income from continuing operations in a separate line. That is what they said in this. The nature of the item and the effect of financial statement effect, right? The nature of the item, that it was a tornado, and the effect, what damage it created, the dollar value, will be disclosed on the face of the income statement or in the notes. So either you can show it on the face, the nature and the financial effect. I'm just talking about the second sentence right now. See, I'm only talking about the second sentence right now. The nature of the item and its financial effect should be disclosed on the face or in the notes. Footnotes means notes. So on the face of the income statement or in the notes, you will have to show the nature and effect. The first sentence, you will have to show on the face. Here, you don't have a choice. You will have to show it on the face. Face means on the income statement. Okay. Here, you don't have a choice. First sentence, you don't have a choice. You have to show it on the face. But the second sentence, the nature and effect of that item, you can show it on the face or in the footnotes. Okay. So this is what I was talking about, multi-step and single step. So this is the multi-step income statement. Let's first go through the income statement. Okay, let me show you the income statement, then I'll come back to the theory. Okay, so for income statement, we write for the year ended. For the year ended, right? And this is in thousands. So we show, see, net sales. Although we are using the word net, it comes under the gross concept. Remember, we just spoke about it. That revenues and expenses are shown gross, gains and losses are shown net. This gain over here is a net amount. This is a net amount. Because this is proceeds, the sale proceeds minus the net book value of that item is the gain. We are showing straight away the gain. $50 is the gain. Right? So this is the net concept. So although we are using the word net sales over here, actually it is a gross concept. So don't go by the wording. Okay. Similarly, we are using the word gross margin over here, but this is actually the net amount. Net of this minus this, 650 minus 410 is 240. So this is the net amount. It falls under the net concept. Although the name is gross margin. Why the name is gross margin? Because finally, when we come to the net income, that is called net income. That is called net. See, net income. It's not called net profit in the US. It is called net income. Okay. So this is a net concept. This is a net income also, and it is a net concept also. You get questions on these. That is why I'm spending time. Okay. Don't think that, this is not a waste of your time. They ask you specific questions. Net income falls under the net concept. Gross falls under the gross margin, falls under the gross concept, because net sales and cost of goods sold both are gross. So gross margin, although it's a net amount, okay, it's a net amount. Okay, so this one is tricky actually. It's a net amount, but it falls under the gross concept. Pardon me. It is a net amount, but it falls under the gross concept. So all your revenues, expenses fall under the gross concept. Okay. And gains and losses only fall under the net concept. And of course, your net income is your net concept. Another question that they ask you, another type of question that they ask you is tax related. Is it gross of tax or net of tax? See, income tax expense is here. Anything that comes before the income tax line is all gross of tax. Gross of tax. Anything that comes below the income tax line is all net of tax. That means now if they ask you what is net sales, and they have given you 4 options, it's a multiple choice question. They have given you 4 options. Net sales is a net concept, but gross of tax. Net sales is a net concept, but net of tax. It's a gross concept, gross of tax. It's a gross concept, but net of tax. These are the 4 options. It's a net concept, gross of tax, net concept, net of tax, gross concept, gross of tax, gross concept, net of tax. What is the answer? Answer is it's a gross concept, gross of tax. It's a gross concept and also gross of tax because it is above the income tax line. Anything that is above the income tax line is gross of tax. And net sales is a gross concept. We know that. So answer is gross and gross. Same question asked for gain on sale of available for sale securities. Same question with the 4 options. Is it net and gross? Is it net and net? Is it gross and gross? Is it gross and net? Answer is, it is net concept, but gross of tax. It's a net concept. Gain is a net concept, but it is above the tax line, so it is gross of tax. So answer is A. In this case, answer is A. It is net concept, gross of tax. Okay, so that is why I'm spending time on this. And also because today is the first class, I'm going a bit slow. After today's class, at the end of today's class, maybe I'll check with you if the pace is okay. Do you want me to go faster or slower? Then I will adjust accordingly. But today it's the first day, I'm going slow. So multi-step income statement, you have net sales minus cost of sales is your gross margin. Then you have selling, general and administrative expenses, depreciation, you get income or loss from operations. Right? So your first break was here at gross margin level. Then your second break is here. Then other revenues and gains, interest revenue, gain on sale of available for sale securities, other revenue, right? Other expenses and losses, interest expense, loss on sale of fixed assets, restructuring expense. Now you got your income before income tax. This is your third break over here. Then you have income tax expense, income from continuing operations. Fourth. Then you have discontinued operations, net of tax. And finally, you have net income is your fifth. So if I put Roman numbering here, the first is gross margin. Then income or loss from operations. Then you have income before income tax. Then you have income from continuing operations. And finally, you have net income. There is no numbering like this. This is just to show you I'm doing this numbering. There is no such numbering. Okay. So the point is, first of all, okay, let's start from here. Income from continuing plus discontinued is your net income. Income from continuing plus or minus, depending on whether it's a income situation or a loss situation. Here in this case, it's a loss situation. Discontinued operations has a loss of 25. So 50 minus 25, net income is 25. Right? So income from continuing and discontinued together is your net income. Plus or minus, that depends on whether it's a positive number or a negative number. But basically, income from continuing plus discontinued is your net income. That means if a company does not have any discontinued operations, then in their case, income from continuing operations is also the net income. If this is not there in a particular company's case, then their income from continuing operations is also their net income. Okay. Another interview question. If a company's income from continuing operations is same, income from continuing operations is same as net income, what does it indicate? It indicates that they don't have any discontinued operations. That's your interview answer. Okay. If a company's income from continuing operations is same as net income, what does it mean? It means that they don't have any discontinued operations. Now let's go further up. So this part is clear. Income from continuing, discontinued is your net income. Now what is income from continuing? It has two parts to it. Income from continuing also has two parts to it. In a multi-step income statement, it has two parts. And that is why I was using the word break. You have a break over here. Income loss from operations. That means this is your operating part. This is your operating part or the operating section of income from continuing operations. And operating section means what is your core operation? like I said, in case of pen manufacturing company, it is pen. In case of furniture manufacturing company, it is furniture, and so on. If it's a finance company, then interest income, interest expense will be part of your operating section, not non-operating. Here, income, interest, revenue, interest expense is non-operating. Other revenues and gains are non-operating revenues and gains. This is the non-operating section of your income statement. That means these are things that you are not, this is not your core business. Earning interest is not your core business. You had some excess funds, you had invested it somewhere, you got interest on that. Or available for sale securities, this is not your business to buy and sell securities. Your business is manufacturing of pens. But yes, you had some excess funds, you had invested in some securities, now you have sold those securities and you made a gain. These are not your core operations. So they are part of your non-operating section. But like I said, if you are a finance company, buying and selling securities is your core operations, then the sale of available for sale securities, in that case, the classification will also not be available for sale, right? Because this is a separate class. But basically selling of securities will then become part of your operating section. If your business is buying and selling securities, right, then it is your operating section. So you have to read the question very carefully in the exam. What is, if they have indicated? If they have not indicated anything, then of course, interest, revenue, interest expense, available for sale security, selling of fixed assets, etc. will all come under non-operating if the question is silent. But if the question has specifically said that it's a furniture manufacturing company and they have sold furniture, then it will not come here in non-operating, it will come in the operating. Clear? So this is your operating section, non-operating section. Operating plus non-operating is your income from continuing operations, right? If you see here, income or loss from operations is -10. And and then you have other revenues and gains of 350, other expenses and losses of 190. So this plus 350 minus 190, this, like, three of them together is 150, right? 350 minus 200, basically 190 and 10 is 200. So 350 minus 200 is 150, right? So your operating, this is your operating part. These two are your non-operating, 350 and the 190. Operating and non-operating is your income from continuing operations. But yes, of course, you will break it here once, income before income tax, show the income tax expense, and then your income from continuing operations will come. Clear? So far? Now, remember, the operating, all the revenues and expenses, are gross concept, gains and losses are net concept. Okay. And anything above income tax line is gross of tax. Anything below the income tax line is net of tax. That is why we show discontinued operations net of tax, because it is below the income tax line. So anything below the income tax line is all net of tax, right? This is also obviously net of tax because tax has been deducted, but we don't have to write it because it is obvious. But discontinued operations, we have to write net of tax. Okay. And then net income obviously is net of tax. Net of tax. Okay. So whenever we say net income, it always means net of tax. There is no doubt about it. Like, don't be under a doubt. Net income means net of tax. If it was not net of tax, it would be called income before income tax. Okay, guys, just give me one moment. In fact, let's take a quick, 5 minutes break. We will resume after 5 minutes. Okay, normally for a 7 to 10 class, we'll take a break at 8:30 just for 5 minutes. biological break if somebody wants to go to the washroom, have some water, etc. So let's do that right now. Okay, and then we'll resume in 5 minutes. All right, welcome back. Let's resume. So, guys, is everyone back? Can I start? Are you guys there? Okay. So, so yes, and okay. So why is it called net sales if it is a gross concept? Because we are showing the sales net of discounts and returns. Less discounts and returns. That means gross sales less any sales returns, less any discounts is your net sale. Right? That's why it's called net sale. As a concept, it falls under the gross concept, but yes, it is net of sales return and discounts. Discount is something we will talk about later. There is something called a trade discount. There is something called a cash discount. Trade discounts are not shown in the books. Cash discounts are shown in the books, right? So we'll talk about it. Trade discount is like 40 and 10 kind of a thing, 40 and 10. If you have, has anybody been to the US? Have you ever been to the US? Anyone? Yes or no? Okay. Okay. So, you will see, like in India, when you go to a mall or somewhere, you see, they have written flat 50% or up to 50%. Like that, they write. In the US, in many places, you will see something like this, 40 and 10. Discount, okay, 40 and 10. Now, 40 and 10 does not mean 50. It is not equal to 50. 40 and 10 is not equal to 50. 40 and 10 basically means if it's a $100 item, we are giving you a 40% discount. So it is 60. On top of that, we are giving you another 10% discount. That means $6. So it is 54. So ultimately, you have to pay 54. But how much discount did you get? 40 and 6, 46. But it is written like this, 40 and 10. 40 and 10 is not equal to 50. 40 and 10 is equal to 46%. Right? So, so that is how, it is. It is written most of the times. Cash discount is written in a very different format. Like this. 2/10, comma net 30. 2/10, comma net 30, which basically means pay within 10 days. If you pay within 10 days, then we will give you 2% discount. Or else you pay the full amount in 30 days. Although it says net, but you have to pay the full amount if you're paying. If you're not paying within 10 days, you pay the full amount in 30 days. Okay, so in 2/10 net 30, 10 is days, 30 is days, and 2 is the discount percentage. So if I say 5/10 net 20, that means if you pay within 10 days, I will give you a 5% discount. Otherwise, you pay the full amount in 20 days. Right? So that's how it is. All right. We'll talk about discount later also. Now, see, restructuring expense is something restructuring. The company has entirely restructured itself. Okay. Maybe from a geography based business, it has gone to a product based business. That means earlier they were structured as US, Latin American countries and Canada, Europe, Middle East and Africa, Japan, Australasia, Pacific. Japan, Asia, Pacific and Australia, they were structured like this. Now they have completely restructured themselves to say, we are not going to define ourselves by geography. We are going to define ourselves by the products that we, or the lines of businesses that we have. So maybe cosmetics, beverages, consumer durables, this kind of structuring is done. Complete restructuring, or any other kind of restructuring, right? So it's not a normal thing to happen every year. Restructuring does not happen, right? Restructuring may happen once in 20 years, 30 years. It may never happen in the case of some companies. It may happen once in 10 or 20 years in the case of certain companies, right? So it is an unusual, infrequent item. So it is shown separately as a separate line item, but where? In income from continuing operations. Because this whole part up to this point, is income from continuing operations. Right? So it is a separate line, unusual or infrequent or both, is a separate line item in the income from continuing operations section of the income statement. Clear? So this is an example of a multi-step income statement. If you see a single step income statement, then you will be able to know the difference. In a single step, all the revenues are put at one place, all the expenses are put at one place. It's single step. So let's look at that so that we can make the comparison. See, all revenues are at one place. Revenues and gains. So there is no operating, non-operating here. Everything has been put at one place. Of course, these are the operating. Probably that depends on the nature of the company. Interest revenue could be operating, may not be operating. But the word revenue has been used, that means it is operating. Okay, normally we don't use the word revenue for non-operating things, right? Normally. So there is no strict bifurcation. There is no strict bifurcation between operating, non-operating. All the revenues and gains, revenues and other items have been put at one place. Similarly, all the expenses and other items have been put at one place. Now you have total revenues, 1000, total revenues and other items, total expenses and other items, 950. So you have income from continuing operations, 50. Discontinued is still shown separately. Discontinued is shown separately. And so your net income is 25. Right? So answer obviously would be same, 50, 25 and 25. Right? This is of course minus. Right? So 50 minus 25 is 25. So answer obviously would be the same, but the presentation is different. Okay? Is that clear? All revenues and other items at one place, all expenses and other items at one place, and then just do a minus. Income from continuing operations, discontinued is separate, and net income. Right? And in the multi-step, we had this format where you have the operating section separate, non-operating separate, the whole of it together is income from continuing, and then discontinued, and then the net income. And here also, you are breaking it at 3 or 4 places. First, you are breaking it at the gross margin. Net sales minus cost of sales is gross margin, so you are breaking it here at once. Then you are breaking it here, income loss from operations, and then you are breaking it here, income before income tax, and then finally income from continuing operations, and then of course discontinued and net income. So you are breaking the income statement at 3 or 4 places. Why I'm using the word breaking is, if I go back to class 11th again, we used to prepare the trading and profit and loss account. Trading and profit and loss account. So we used to have opening stock here, purchases, sales over here, closing stock, and the gross profit. And we would break this account into 2 parts. The gross profit would go here, and then you would have the other items of expenses in the profit and loss part of the, and then net profit, right? So here we are breaking the whole account into 2 parts. At the gross profit part here, and at the net profit part here. We are breaking it twice. Whereas here, we are breaking it 3 or 4 times. Okay. That's why I was using the word breaking. All right. Now, let's proceed. Okay, so I had skipped the initial theory part here. Multi-step income statement reports operating revenues and expenses separately from the non-operating revenues and expenses and other gains and losses. Benefit of multi-step income statement is enhanced user information, because the line items presented often provide the users with readily available data with which to calculate various analytical ratios. Right? So when we do ratios, we will understand how multi-step is more useful in calculating ratios than single step. And this was actually a question, and that was the answer to this question. So let's also quickly see this. You have sales revenue, sales returns, sales discounts. So in the income statement, you will only show the net amount of these 3, net of this. 380 minus 30, which is 350. If you go to the answer, you will see net sales has been shown at, okay, 650 is because they have other items also. Okay, 1 second. So this is 350. Then service revenue is 200. Rental revenue is 100. Now this 350 and 300 is your 650, which is going to your income statement. Similarly, the cost part, cost of goods sold, cost of services sold, cost of rental income. This is the cost part. $410. Right? So this is basically your first break in the income statement. 650 minus 410. 650 minus 410, gross margin 240. Okay. Then comes your other items, salaries, freight out, commission, advertising, insurance expense, depreciation, income tax expense, interest revenue, other revenue, gain on sale of available for sale securities, interest expense, loss on sale of fixed assets, restructuring expense, loss on discontinued operations. Discontinued is obviously a completely separate thing, right? Discontinued is completely separate. But from the gross margin part, this is the gross margin part, 650 minus 410. You will reduce the salary, the freight out, commission, advertising, insurance, depreciation. Income tax expense, of course, will come much later. Interest, other revenue gain are non-operating items. Interest loss restructuring are non-operating items, right? So after, and income tax is absolutely at the end. So here also you are breaking it once, right? 650 minus 410 gross margin, margin minus these items is your income loss from operations. Income or loss from operations, right? And this, of course, they have clubbed all those expenses here in general and administrative 70, selling 100, and depreciation 80. Let's do it. Let's do it ourselves. So salary expense, there is a star asterisk here. Salary expense $20 relates to salaries of for salespeople, and 50 relates to salary for officers of the company. So that means out of this 70, 20 is selling expense because it is salary of salespeople, and 50 is the general and administrative. General and administrative expense because that is for the office people. Freight out is selling. Commission is also selling. Advertising is selling. Insurance is general administrative. Depreciation is separate line item, right? 80. Now let's do it. So selling is 20 from this and then these three. This is 80, right? 80 and the 20 from the salaries. So 100 is the selling expense. Depreciation is 80 as it is, right? Depreciation is 80 as it is. So let's look at these two first. Yes, selling is 100, depreciation is 80. Correct? General administrative. You can get a TBS question like this. You have to prepare the income statement. Okay, so you need to know all this. General administrative is 50 from the salaries and 20 from here. 50 from salary and 20 from here, which makes it 70. Is 70. Clear? So we are breaking, see, again, one more time, we are breaking the income statement here at one place to get the gross margin. Then we are breaking the income statement here at one place to get the income or loss from operations. Income slash loss from operations. Income tax expense will go to the, like, come much later. Then we will have the other, this thing, right? Other revenues, the non-operating gain, non-operating revenues and gains, and then non-operating expenses and losses. And then we will break the, again here, income before income tax. Then we will reduce the income tax. And then we will get income from continuing operations. And then we will do the loss on discontinued. And then we will get the net income. Is that clear? Okay. All right. In the single step, there's nothing. There's like, as we saw, all revenues, everything at one place, revenues and gains, all expenses and losses at one place. Here, you don't have to think much. It's easy. If you're lucky, you will get single step income statement as a TBS, right? But remember one thing, you still have to show interest revenue separately, interest expense separately, depreciation is a separate line item, restructuring is a separate line item. It is unusual or infrequent or both category. Restructuring expense is in the unusual or infrequent or both category. Okay. All right. Now coming to income from discontinued operations. Okay, income from discontinued operations. Let me first discuss before we go through the module. No space to write. Yeah, okay, I can write here. All right. So discontinued operations. Okay, let's understand the concept first. Then we'll go through the module. It is basically a component of an entity. Okay, a business, right? A component or a group of components. A different business of the company, or it could be a subsidiary of the company, those kind of things basically that have been disposed of or is classified as held for sale. Okay, that means basically it has to first meet the definition. Is it a component of the entity or not? Right? Or is it a separate business of the entity, etc.? So I'm just writing component here for the moment. Whether it meets the definition of the component. If it meets the definition of component, then we will have to see whether this component has been disposed of or is classified as held for sale. Either of the two, either it has been sold off or it is classified as held for sale. Then we will show this in discontinued operations. Now, what does that mean? So suppose let's take an example. Let's take an Indian example so we'll be able to relate better. Suppose Maruti had 800, okay? It is no longer there, but it had 800 Alto, WagonR, A-Star, then maybe Desire, Swift, then Brezza. Brezza is Nexa, but I'm considering all at one place. Brezza, Vitara, Grand Vitara, Ciaz, maybe Ertiga, Baleno, Ertiga, Grand Vitara, Ciaz. Now, understand this carefully. if Maruti 800 meets the definition of component. Okay. Definition of component is not given in your book, so don't worry about the definition. But does it meet the concept is, does it meet the definition of a component? Yes or no? If it meets the definition of a component, and now Maruti as a company decides to dispose of this business of Maruti 800, right? The entire business of Maruti 800. We are not talking about a single car. We are talking about as an assembly line, as a factory, as a business. They sell it off to some other player. Okay. Now they might rebrand it, sell it by some other name, whatever. But question is, if Maruti 800 meets the definition of a component and Maruti as a company decides to sell it off, then it will come under discontinued operations. Now, what does it mean? It will come under discontinued operations. What does it mean? What it means is that in the income statement, we have the continuing operations, which we have already discussed. We have the discontinued operations, which we are discussing now. 3 items, only 3 items. There will not be any fourth item here. There are only 3 items that will appear over here in discontinued operations. What are those 3 items? The income or loss from operations, income or loss from operations, the impairment loss, and the gain or loss on the actual sale. Now, what does it mean? Maruti 800 meets the definition of a component and it is either sold off. What did we write here on top? That it is a component that has already been sold off, that has been sold off. That has been sold off. A component that has been sold off, disposed of, or is classified as held for sale. That means the company has classified it as held for sale. We are holding it for sale. Either it has been sold off or it is held for sale, classified as held for sale. Then it will come under discontinued operations. That means, why am I writing income or loss from operations then? Because although the company has classified it as held for sale, it will not stop the operations. The manufacturing will continue. The sale of the car will continue, right? It is going to continue as usual. But as usual in the sense that company knows, the management knows that we are looking for a buyer to sell it off. So that activity has started. Board has passed the resolution that we are selling off Maruti 800. The management has started actively looking for buyers. They are reaching out to different car companies or, to figure out who will buy this. So all that is happening, but operations are also continuing. It's not that manufacturing has stopped. Operations are continuing. Operations will continue till the last day. And, basically in the same factory, operations will continue, but now there will be a new owner. Okay, so operations will not be impacted even for a single day, let's say. Okay, so operations are continuing. Jan to December is the year. Classified as held for sale means certain criteria have to be met. There are 5-6 criteria that need to be met. Again, those criteria are not given in your book, so don't worry about the criteria. But there are 5-6 criteria. Like I said, has the board approved it? The board of directors approval is there or not? Is the company actively looking for a buyer? Can it be sold in the as is position? As is position. Nothing needs to be done to sell it off. The way it is, it will be sold like that. as is position, right? So there are 5-6 criteria like this. If those criteria are met, then we will say that it is classified as held for sale. And the moment we say it is classified as held for sale, it will come under discontinued operations. Now, suppose on April 1st, the board resolution was passed and all the conditions were met. All the conditions that are required are met. So on April 1, it has been classified as held for sale. It has been classified as held for sale on April 1st. On December 31st, we are preparing the financial statements. We are preparing the balance sheet. We are preparing the income statement. So my question to you is, and operations are continuing. On April 1, it was classified as held for sale, but it has not been sold yet. We have not been able to locate a buyer yet. So on December 31, it is still with us. Maruti 800 is still with us. We have not been able to find a buyer. We are actively looking for a buyer. We have given newspaper ads or whatever, whichever way we are doing it. We are actively looking for buyers. But it is still with us. On December 31, we are going to show any income or loss from its operations because we are still continuing to operate. So any income or loss from its operations, we are going to show in the discontinued operations section. Now, any sale of Maruti 800 car will not come in the revenue, in the net sale, in the income from continuing operations section. It will not come here anymore. Okay, because it is a discontinued operation now. It has been classified as held for sale. Okay. So the revenue from Maruti 800 will not come in continuing operations. The cost of goods sold or expenses of Maruti 800, the salaries, the depreciation, nothing will come in continuing operations. Now we will show just one amount here, the income or loss from operations. That means we will prepare its income statement. We will prepare its income statement and we will see what is the net income or loss coming from its operations. I mean, the income or loss coming from its operations. And we will write that amount over here as one single line, income or loss from operations. Now, my question to you is, suppose there was a $3 million loss in Jan, Feb, March, $3 million loss. April to December, there is $9 million loss. So overall in the year, there is a $12 million loss from this discontinued operation. When I prepared the income statement on December 31, in the discontinued operation income or loss from operations, how much am I going to show? Am I going to show $3 million here or 9 or 12? Yes, come on, guys. Whatever is your answer, 3, 9, 12, write that in the chat box. Or simply write IDK if you don't know. Okay, great. So lot of correct answers, but lot of wrong answers also. Answer is, when we prepare the December 31 financials and we are showing the income or loss from operations of Maruti 800 in this example, we are going to show the entire $12 million here. Entire $12 million here. Not 3, not 9. Because once it has been classified as held for sale, once we know that it is a discontinued operation, then its entire year's number will appear over here. One of you, or I think couple of you, said that we will show 3 over here in the continuing because at that time it was continuing. And then we will show 9 over here because now from April onwards it is discontinuing. While I know you have applied your own logic, But US GAAP says that no, it is not going to be 3 and 9, it is going to be entire 12 over here. The reason, logic is that one of the qualitative characteristics of financial statements, right? Financial statements have many qualitative characteristics. It is not just about the dollar values that we are writing over here. There are certain qualitative characteristics that financials have. And what are those qualitative characteristics? Let me quickly write here. You don't have to write it because it is not there in your module. But just to give you an idea, qualitative characteristics are divided into two parts. The fundamental qualitative characteristics and enhancing qualitative characteristics. The fundamental, that are absolutely fundamental to the preparation of the financials. Your, qualitative characteristics are fundamental ones are that your financials have to be relevant and reliable. Your financial statements must be relevant. They must be reliable. Reliable is also called faithful representation. Faithful representation. That means they must faithfully represent what has actually happened. They must faithfully represent what has actually happened. It should not be the case that you had a loss of $1 million in reality, but your financials are showing a profit of $1 million. That means it is not faithfully representing what has actually happened, right? So reliability, relevance is of fundamental importance. Now, in relevance, there are three. PCM. Your financials must have a predictive value. They must have a confirmatory value. And materiality is one of the important characteristics, materiality. Faithful representation also has three items in it. Completeness, neutrality, and free from error. I'll explain these quickly. And enhancing qualitative characteristics are those that enhance the quality of the financial information. They are not fundamental, they are enhancing. So things like, it is comparable. Your financials must be comparable to financials of other companies, or financials of this year must be comparable to the financials of previous year. So comparability. Timeliness, understandability, and verifiability. Let's quickly talk about these. Predictive value means by looking at the financials of this year, the readers must be able to predict what they can expect in the coming year. That is the predictive value. By looking at the financials of this year of any company, you pick up the financials of Microsoft, you pick up the financials of Apple, you pick up financials of Reliance Industries, you pick up financials of any company. By reading the financials of this year, you will have a fair enough idea of where the company is heading, what the company is doing, what kind of financials you can expect in the next year. right? What kind of revenues you can expect in the coming year. Of course, it won't be precise. It will be an estimate, but you will have a reasonable idea of what to expect from this company in the next year. Predictive value. Confirmatory value is what you had thought last year about this year is kind of getting confirmed. Last year you thought that this company will be in the range of $20 million, 20 to $25 million. And when you see the financials of this year, it is in that range, more or less. Confirmatory value. Your previous understanding is being confirmed now. So they go hand in hand. This year's prediction will become next year's confirmation, and so on. Materiality means anything that is any information, any piece of information that can have an influence on the decisions of the users is material. Users, okay, users are divided into two parts: primary users and secondary users. Primary users are the investors, the shareholder, the investors, potential investors, right? So investors are basically shareholders, number one. Then you have potential investors. Guys, just give me 1 second, please. Investors, potential investors, lenders, and creditors. These are the primary users of the financial statements. Everybody else is a secondary user, like Securities and Exchange Commission, right? Or any other regulator, income tax authorities, the IRC or the IRS, Internal Revenue Service, right? Or anybody else, banks, financial institutions, government, researchers, anybody else is a secondary user. A lot of students they think that Securities and Exchange Commission, the income tax authority, regulators, they are primary users. They are not. They are secondary users. Primary users, if you closely watch, anybody whose money is involved, people whose monies are involved are primary users. Investors have invested their money in the business. Potential investors are going to invest money. Lenders have lent money to the business. Creditors have given raw material on credit, so their money is also blocked. Whosoever's money is involved, they are the primary user. And for other people are just using the information for their own benefits. Income tax authority wants to take income tax from you. Government wants to take certain other kinds of taxes from you, or whatever. SEC will charge a filing fee from you. So they're actually making money from you. I mean, I'm not saying this in any negative sense, not in any derogatory sense, but factually, you are paying money to them. Of course, when you have losses, you also get refunds and all. I mean, income tax refund and all. So, I mean, I'm not saying that in that sense, but people whose money is not involved, like who have not given money to the company, people who have given money to the company or are going to give money to the company are primary users, and people who are not, they're just using the information for other purposes, are secondary users. Anyways, that's a different discussion of users. Point is that any information that can influence the decisions of the users, and when I say users over here, I'm talking about the primary users, because it is their decision. Should I give money to this company? Should I lend money to this company? Should I invest in the shares of this company? Should I give raw materials on credit to them? If their decision is getting influenced that is a material information. So all the material information must be present in the financials, right? And that also relates to completeness. Completeness also means that anything that is material to the users must be captured, must be presented, right? It should not be left out. Neutrality means, if I prepare the financials, it will look something different. If you prepare it, it will look something different. That should not happen. That should not happen, right? Whether I prepare or you prepare, it should be the same, because ultimately it should faithfully represent what has actually happened. So whether I prepare it or you prepare it, how does it matter? As long as, of course, as long as we know the rules, as long as we know US GAAP, of course, that is that is a given, that whoever is preparing knows US GAAP, right? That's a different discussion. But here neutrality means whether I prepare it or you prepare it, it should be the same, right? We should not bring any bias into it. No biases. Right? It has to be objective, not subjective. No subjectivity. Those kind of things. Of course, we will see later that subjectivity is involved in various places wherever estimates are there. There are lots of estimates involved in preparing financials. So their subjectivity would be involved to some extent, right? But neutrality means that, yes, if I would make those estimates versus you would make those estimates, it would pretty much be the same, right? We are not using our own biases. Freedom from error does not mean arithmetical accuracy. Freedom from error here means the correct selection and correct application of accounting principles. Principles means methods, right? So whether I should apply LIFO or FIFO, whether I should apply completed contract method or percentage of completion method, that selection and application of the accounting principle has to be correct. Here, freedom from error is not arithmetical accuracy. Okay. And then you have these comparability, both intra and inter. Inter means your company's financials with another company's financials. You should be able to compare. Intra means your own financials with your own financials, this year versus previous year. You should be able to compare, right? That basically means that especially for intra-firm comparison, consistency, that means the methods that you followed last year are the same that you followed this year, will be the same that you will follow next year. If you are following FIFO, you are continuing to follow FIFO year over year. And so that's how your last year's financials will become comparable to this year. You were following straight line method of depreciation, you are still following straight line, Now you can compare. But if you were following straight line and now you have moved to declining balance method, then you move to units of production method, then you move to sum of the year's digits method, you will not be able to compare. So consistency is a key in comparability. Then, of course, timeliness. It has to be produced timely, on a timely basis. And we will see when we talk about SEC reporting, we will see how much SEC time, how much time does SEC give. For annual financials, it gives 60 days or 75 or 90, depending on the type of company. For quarterly, it gives 40 days, 45 days, depending on the type of company, right? So it has to be produced timely. Understandability means it must be understandable by anyone who has the knowledge of accounting and finance. See, understandability here does not mean even an illiterate person will understand. Obviously, that person cannot even read. Or even a literate person, but who is not financially literate or accounting literate will understand. No, they are not going to understand. If you show the financial statements to someone who has never done commerce, never done anything to do with accounting or finance, will not understand. So understandability means that anyone who has the requisite knowledge to understand financials will be able to understand your financials also. If they are not able to understand your financials, then there is a problem. Okay. And verifiability means it must be capable of being verified. That means it must be supported by, documents, or any other form of verification. So basically it must be supported. Okay. It must be capable of being verified. And also it means that, nothing can enter into the financials directly. There is a path that one has to take. A transaction happens. The transaction is captured by way of a journal entry. The journal entry gets posted to the ledger. So ledger posting happens. Then we prepare the trial balance, and from the trial balance, the financial statements are prepared, the balance sheet, the income statement, etc. So nothing can come directly. A transaction happened and it went straight to the balance sheet without going through this route is not allowed. Not allowed. If a transaction has happened, it has to take the correct path of journal entry, ledger posting, trial balance. Then it enters into the financials. So it must have taken that route. So if I go backwards from the balance sheet to the trial, I must be able to identify. From the trial, if I go to the respective ledger, I must be able to identify that, yes, this is the transaction that happened. I must be able to go to the journal and see that transaction. And in the journal, along with the journal entry, the voucher, along with the journal entry voucher, there will be the supporting documents. The supporting documents. That means if the company has sold something, there will be the invoice, there will be the shipping document, right? If the company has, and then of course, there is basically it's called a complete voucher package, right? If the company has purchased something, for example, there will be a purchase requisition, there will be a purchase order, then there will be the invoice of the vendor, then there will be a goods received note, then there will be probably a store received note, right? The goods received note will be at the gate of the factory, the store received note will be at the store, that the storekeeper has also received the item, right? And then finally, there could be a user department's approval or acknowledgement that they have received, not approval, that acknowledgement that they have received the item, right? So there will be complete documentation, support that will go with the voucher. So that is the verifiability part. Right? In the case of sales, there will be a sales order. There will be, of course, there will be a purchase order of the buyer. Based on that, we would have prepared a sales order. There would be a credit authorization approval. Credit department must have authorized credit authorization that we can give them goods on credit, right? Then, of course, we would have generated an invoice. There would be a shipping document that it has actually been shipped to the customer, right? Hello. Okay, so anyways, this discussion, you don't have to sort of I mean, this was just for your understanding. Certain basic understanding must be there to understand far better. So this is part of that basic understanding. This is not there in your straight away, in your syllabus. But it is important for your understanding. So therefore, so we started this discussion from this predictive value, right? So now let's come back to this. The reason why we are going to show the entire year, $12 million over here, is because when the readers look at the financials and if they see 3 over here and 9 over here, they are going to think that, okay, this $3 million, next year also it will be there. Because one of the qualitative characteristics is predictive value. So by looking at the current year's financials, we are also kind of predicting the future year's financial. Whereas in the future year, this 3 is not going to be there because it is part of discontinued operations. Company would have sold Maruti 800 by then. So showing 3 here and 9 here would be wrong, in terms of the expectations that you're building in the minds of the shareholders or any primary user. So therefore, entire 12 will be shown over here and nothing in the continuing operations because it is not a continuing operation anymore, right? That is the logic. Okay, so now coming to the other items. The income or loss from operations we have discussed. Then the impairment loss. Impairment loss is what is the value of Maruti 800 overall as a business for Maruti. If Maruti 800's value was suppose $4 million, now on the date it was classified as held for sale, they got a fair valuation done and they found out that it is now being valued at, let's say, $3 million. That means there is a $1 million impairment loss. $1 million impairment loss. So this impairment loss will also come over here, right? And then when it finally gets sold, the actual gain or loss on the sale. Now, in this particular example, which I gave, that till December 31, it was not sold. That means when I prepare this financial, there will only be 2 items over here, the loss of 12 and the impairment loss of 1. This will not be there. Next year, suppose next year, it actually gets sold on March 31st. On March 31st, it gets sold for $2.5 million. And from Jan to March, there was a loss of $3 million. Jan to March of next year, there was a loss of $3 million. Let me write over here. Right? This is next year. This is 2024. This was 2023. So on March 31st, it was sold for 2.5 and Jan, Feb, March, there was a loss of 3 million. So when I prepare the next year's financials, right, in the discontinued operations, I'm going to show here $3 million. Impairment loss, there will be nothing, but gain or loss on the actual sale will be, it was 3. Last it was 3 because we had brought it down from 4 to 3 by booking an impairment loss of 1, right? So we had brought the value down from 4 to 3 and we had booked an impairment loss of 1, right? This one, the 1. So now its value is standing at 3. We have sold it for 2.5. So now there is a loss of $0.5 million. So that will appear over here. So in any particular year, out of the 3 items, most likely there will be only 2 items. There could also be all the 3 items if it is sold within the same year. Right? So maximum there will be 3 items, but there could be less than 3 also, but there can never be more than 3 items. Clear? Clear? Now, one more aspect. Remember, we said discontinued operation is always shown net of tax. So all these values that I've written over here will not be 12 and 1. It will be 12 minus the tax. Whatever is the tax rate, suppose 30%. Then instead of 12, we will write 12 minus tax 30%. That means minus 3.6. So it will be 8.4. So we will write, instead of 12, we will write 8.4 over here. Instead of 1, we will write 0.7 over here. 1 minus the tax. 0.3 is the tax. So 0.7, right? 30% is the tax. So 0.7 will appear over here. Okay. Now there are two ways of presenting this. There are two ways of presenting it. One way of presenting it is that you show the first item in the inner column at 12. You show the second item in the inner column as 1. You don't have the third item, so this becomes 13. And then you show less tax, right? And then you show in the outer column, right? Either you can do this, or you can do what I showed here. You show 12 here and you do the less tax over here itself. And you show outer. Then you show the next item. This is the first item. Then you show the next item 1, less tax. And you then show 0.7 in the outer. And then the total comes. Answer will obviously be the same. But in one case, you are doing it at an aggregate level. Here you are doing it at an aggregate level. And here you are doing at an item level, item by item. For each item, you are deducting the tax and then showing the net amount outside. Whereas in the first one, 1 and 2, in the first one, you are showing the gross amounts in the inner column, totaling it, and then doing the less tax at an aggregate level. Both are fine, both are allowed, right? So, all right. So now, just one more aspect here. All this discussion that we had, we said that if Maruti 800 is a component of the entity which has been sold off or is classified as held for sale. Now, in this discussion in 2023, we said that it has been classified as held for sale. So it is coming in discontinued operations. In 2024, it has been sold off. So it is coming in discontinued operations, either classified as held for sale or actually been disposed of. In either case, it will come in discontinued operations, right? In 2023, it was classified as held for sale. In 2024, it has actually been sold off. So any component of the entity that has been disposed of or is classified as held for sale will come in discontinued operations, and only 3 items will appear in the discontinued operations section. Only 3 items. There is no 4th item. But yes, depending on the situation, there can be less than 3 items. There can be 2 items. Now, one aspect that is still pending, which we have not discussed, is what if Maruti 800 is not a component? It does not meet the definition of component. Then what happens? Suppose Maruti 800 does not meet the definition of a component, but suppose small car segment, as a segment, it meets the definition of a component. Then suppose this is, okay, I could be wrong in this classification. So car lovers, please don't get offended. Suppose this is the classification that small car as a segment is a component of the business, mid car segment is a component of the business, big car segment is a component of the business. And now company decides to sell off Maruti 800.
So if it does not meet the definition of a component, then it will not come in the discontinued operations section. In that case, it will come in income from continuing operations. Just like, when you sell furniture, you show the gain on sale of furniture. You sell some machine, you show the gain on sale of machine or loss on sale of machine. Similarly, you will show gain on sale of, Maruti 800 business or loss on sale of Maruti, because it has not even met the definition of a component or definition of a business. And it is also not a subsidiary of the company. It is not a separate entity. So it is not a separate entity, it is not a separate business, it is not a separate component. Then it will come in income from continuing operations, just the net concept, the gain on the sale or loss on the sale. But if Maruti 800 is a component, which we discussed earlier, then it will come in discontinued operations, whatever we discussed. Okay. So it's already 10 o'clock. So we'll end over here. We will do the discontinued operations from the module tomorrow and then continue with the rest of the topics. So right now, let me now take your questions quickly. And just in case any of your questions remain unanswered, don't worry. The topic is not over. Our classes are not over. I will take up your question, or your question will automatically get answered at some stage, at the MCQ stage or at the TBS stage, or, during the class, maybe in a future class. So don't worry about it. Just keep noting your queries in case some of it remain unanswered. Keep noting it. At some stage, it will get answered. Otherwise, you can always reach out to me also directly on WhatsApp. Okay, so I'm just scrolling to see what are your questions. And whenever you ask a question, please give me the exact page number and para number reference, okay? Okay, so Mohit Pal Singh, one second. I think your question is from the balance sheet, is it? Yes, Mohit. So what's your question? Interest payable is your question, right? So here is the interest payable. So what exactly is your question? Mohit? So where do you see these items? You have to tell me the exact para number, page number, para number, and I'll be able to answer your question. See, otherwise it will become very vague. So please tell me which question, which page, which para you're referring to. Interest payable is right here. What else are you referring to here from the balance sheet? Is there anything else that you're referring to from the balance sheet? Current portion of long-term debt. Current portion of long-term debt, as I said, out of, suppose the loan was $1 million, and what is due in the next 12 months, if 12 months or operating cycle, whichever is longer, is 12 months, then whatever is payable in the next 12 months is the current portion of the long-term debt. Right? Current portion of the long-term debt. This is the principal amount I'm talking about. The interest portion will be captured in the interest payable. Right? Interest payable is anyways a current liability, whether it is a 10-year loan or a, because the interest you will have to pay within the next 12 months. I mean, within the next 12 months or operating cycle of the company, whichever is longer. Right? Because interest normally in the US is payable twice a year. It is called semi-annually, right? Basically semi-annually. That means normally it is payable on June 30th and December 31st. So interest is semi-annual, mostly in the US. Of course, question will specify if the question says interest is paid only once a year annually, then it is once a year. You will not challenge the question. But normally, if question is silent, normally interest is payable twice a year in the US, June and December. Right? I mean, dates can be different. It could be April and September, but it's twice a year. So obviously, twice a year, that means obviously it is current, right? It is current. Because in the next 12 months, it will fall due. And this is payable means it is already payable. This is already payable. That means it has already fallen due. Okay. No, there is no such option. So you can call me later. I'll give my number. I mean, you guys have my number already. I'm in the group. I'm in the WhatsApp group, not in the Telegram group. Right. So if you don't have, I'll give my number at the end. But you can reach out to me directly if your question remains unanswered. And anyways, like I said, a lot of questions will get answered with the future topics, because today was just a very basic class. We got introduced to a lot of terms which we will discuss in detail later when we actually reach those topics. For example, interest is covered very much in detail in the bonds module, right? So bonds, there are two modules on bonds. We'll cover at that time in detail anyways, okay? All right. Yeah, so Priyanka, we are using the words expired and unexpired here. That's, yeah. So, I mean, those are the terms that are being used here. Right? So expired means already gone. Like I said, out of 10 years, 4 years have gone. So depreciation of 4 years is expired. I mean, that part of the cost of the machine is expired cost. Right? Out of $100,000, suppose $40,000 is already been depreciated. So that means that is the expired portion, and the remaining 60,000 is the unexpired portion. Okay. So opening and closing stock, Praful, when we calculate cost of goods sold, it will be opening stock plus purchases plus, net purchases, opening stock plus net purchases plus other direct expenses like wages, freight, all that, just like we used to do in our class 11th, right? Trading account. So opening stock plus net purchases plus other direct expenses minus closing stock is your cost of goods sold. Is your cost of goods sold? Yes. From a journal entry point of view, so again, we will cover that when we do inventory. Since you have asked the question, I'll quickly answer it. In the US, we have two systems, the periodic system and the perpetual system. In the periodic system, when you buy inventory, you do debit purchase and credit cash or AP, accounts payable, depending on whether you have paid or not paid. Debit purchase, credit cash or AP. In the perpetual system, we debit inventory. We directly debit inventory and credit cash or AP depending on whether we have paid or not. Similarly, when we sell inventory, in the periodic system, we do debit cash or AR, credit sale in the periodic. In the perpetual, we do debit cash or AR, credit inventory. I mean, not directly credit inventory. Okay, sorry. Credit sale. And along with this, we pass another entry, debit cost of goods sold, credit inventory. So in the perpetual system, sale is always accompanied with this other entry. It's a set of two entries. Whereas in the periodic, there is only one entry. Right, so that is the difference between periodic and perpetual, and we will cover it in the inventory module when we reach there. And hopefully your question will get answered over there, right? Like I said, today is just an introductory class. Okay, Praful, Priyanka, we round FS to thousands. Well, it depends on the size of the company, not necessarily thousands. It could be thousands, it could be, if it's a really, really big company, it could also be in millions. Right? But yeah, generally it is thousands. All right. Discontinuing operations, Pragya, is net of tax. Yes. Yes, it is net concept, net of tax, because we are showing straight away the income loss from operations. We are not showing revenues, expenses. See, the gross concept is only in the context of revenues and expenses, and net concept is in the context of gains and losses. So here we are showing the gain loss on sale. We are showing the income or loss from operations, straight away the income or loss amount, not revenues minus expenses, not like we show the income from continuing operations. So yes, you are right. It is net and this thing, net of tax concept. How do we write 40 and 10 becoming 50? No, 40 and 10 is not 50. That is what I said. 40 and 10 is not 50. It is just to attract customers, they write 40 and 10. So, people, just by looking at something written as 40 and 10, somebody might think that it's a 50% discount. It's actually not 50. That's just a way to attract customers. Like in India also, when they write flat 50%, when you enter the store, it is not flat 50%. There is one section at the corner which is 50%, not the entire store. But outside they have written flat 50%. Right? And so it is not. So it is just to attract customers that, businesses do like this. Okay, Sumit. Then Vikrant, is there any criteria or condition for selection between single and multiple? No, both are allowed by GAAP. Both are allowed by GAAP. There is no such criteria. Revenue and cost is inclusive of tax. Here, when we say tax, Milan, we are only talking about income taxes. So when we say gross of tax or net of tax, we are talking about income taxes, not your GST, VAT, or things like that. Is it gross of income tax or net of income tax is what we are saying. Pragya, not consider this in gross margin. No, this is your other revenues, not your core operations. Your core operations revenue will come in the top part of the income statement. Other revenues will come, in the non-operating. These are non-operating revenues. If a company has any non-operating revenue. All right. Right. Investors versus potential investors. Potential means who are not yet investors. They are potential investors. They are thinking of. So, I mean, well, potential investors then will basically what you're trying to say is that then the entire community will come under this category, right? Everybody is a potential investor. Do you mean that? So here, it has not been defined properly. Like in your module, if you see, it has not been defined in the exact words, like what potential investor means, right? Anybody who is willing and able to, who has the ability and the willingness to invest in the shares of the company is a potential investor. So both ability and willingness must be there. Somebody has the ability but no willingness is not a potential investor. Somebody has the willingness but does not have the ability also is not a potential investor, right? Just like in economics, when we read the definition of demand, right? Demand is when somebody has the ability and willingness to, buy a certain quantity of the certain good at a certain price. So it has not been defined properly, but yes, like I said, anyone who has the willingness and the ability. So somebody who's seriously considering investing in the company is a potential investor. Okay. Ankita, banks can also be lenders. So yes, if they are lenders, then they become primary users. Discontinued operation. Discontinued operation is when it has been already disposed of during the year, or it is classified as held for sale. To be classified as held for sale, there are certain criteria. One of the conditions is that, it must have received the formal approval of the board of, whoever is the decision-making authority, the chief operating decision maker or the board of directors, it has got the formal approval is one of the conditions to be called as classified as held for sale. Okay, now one of the conditions also is, and I'm answering Milan, I'm answering your second question. One of the conditions also is that you have gone ahead so far in the process. You have gone ahead so far in the process that there is now no way of your coming, going back on your plan. That means, it has been made public. It has come in the papers. It has, it's all, the word has spread all over. Investors, I mean, potential buyers are looking at, like Air India sale happened, right? It did not happen in 1 year. It took more than 1 year, but it was a discontinued operation from the time the conditions were met. Eventually it got sold, to the Tatas. So you have gone so far ahead in the process that there is no way of your returning that, that we are not doing this anymore. No. And that condition has to be met for it to be classified as held for sale. That is also one of the conditions, right? That the company has gone so far ahead in the process that they cannot now go back. So obviously, that means it will eventually get sold. Yes, it's a different matter whether it will get sold within the next 1 year, or it might take 14 months, 15 months, maybe 18 months. Time could be, plus or minus, but it will definitely be sold. Okay. Chetan, I have already explained, the approach in the orientation session. Please view that recording, how you should approach FAR or what you should exactly do, right? Of course, like I have taken you through line by line today, I'm going to do that for the rest of the syllabus also. I'm going to take you through the line by line, word by word, right? So that when you study, when you revise at home, it is going to be absolutely quick, because now we have discussed each and everything, right? So it should be very, very quick. And that's the approach we will follow throughout. FQC is the fundamental qualitative characteristics and EQC is the enhancing qualitative characteristics. Ashwathi, yes, that is how the setting is, right? The messages come directly to me. Mohan, I've already answered your question that if it is classified as held for sale, that means the company will now not go back on its words. It has gone far ahead in the process. Mohan, emphasis of matter para and other matter para are part of auditor's report, not part of the notes to the financials. Okay. And we are not talking about auditors here or auditors report here anywhere. We are only talking about the financials and therefore notes to the financials, right? And financials are the responsibility of the management of the company. Preparation and fair presentation of the financials are responsibility of the management of the company, not the auditors. So here, we are not talking about audit at all anywhere. So EOM, OM is not a relevant term to use over here. Okay. Priyanka, yes, of course, it is management's decision, whether they want to use a multi-step income statement or a single step income statement. Of course, and the management's decision will be based on certain aspects like, what do the other, competitors in the industry do? If Coke, presents its financials in a certain way, Pepsi most likely will present the financials in that way so that people can compare, users can compare, right? Or, Unilever will probably present it in a way that Procter and Gamble presents or Nestle presents, right? So if one of them is presenting multi-step, most likely the others would also present multi-step. I'm just saying it is not necessary, but of course, it is the decision of the management, but that decision will not be on the whims and fancies of management. There will be a proper reasoning and logic behind it. As far as GAAP is concerned, GAAP allows both. Schedules for financials, yes, schedules are prepared because see, the face of the income statement is or face of balance sheet is just a one page. And that one page does not explain everything. So there are schedules attached. Okay, Chetan. In case of Sony and Z, now, so Milan, the point is that did they meet all the conditions? Did they classify it as held for sale? Did they already show it in discontinued operations? The answer may be no. Answer may be no. Maybe they were still exploring this idea. Okay. I mean, I don't know the exact details here of Sony and Z, but maybe they were exploring the idea and they had gone far ahead in that process of exploring, but they may not have yet classified it as held for sale. Right? And if they had not classified it as held for sale because all the criteria were not met, then there is no issue. The issue is if they had already met all the conditions and they had classified it as held for sale. So maybe what you need to do is need to go back and check their financials of this particular year when the merger was announced. In those financials, where was this being shown. And by the way, here you are talking about a merger. You're not talking about a discontinued operation. Merger is a different concept. It's a different thing, right? We are talking about discontinued operations. So any other example that comes to your mind, you can go back and check the financials of that year and then check the financials of when it was actually sold. And in both of them, it must be in the discontinued operations, right? If you come across any instance where something was shown in discontinued in a particular year and then it moved back to continuing, please share it with me. Even I would be interested in knowing. Okay, because as per GAAP, once it is discontinued, it will be sold off and done away with. Because that is why they have kept the criteria so stringent that you will only classify it as held for sale when all those 6-7 criteria are met. There are 6 or 7 criteria and they are quite stringent criteria. And one of the criteria specifically says that the company has gone so far ahead in the process that they cannot come back now. Right? So even I would be interested in knowing that if there is any such real life example where company had classified it as held for sale, that means they had classified it before meeting the criteria. That means they had not gone so far ahead in the process, but still classified it as held for sale, which is a violation of GAAP in a way. Right? So if you come across such an instance, please share with me, and maybe I will share with all the students so that we can enrich each other's knowledge. Mohan, disclosure in FS. So yes, disclosure in FS would be there, but yeah, EOM and OM are auditors report, part of auditors report. So not EOM, OM, but yeah, disclosure of course would be there in the notes, right? And Priyanka, I think that answers your question also. Disclosure will be there in the notes. All right, so I think that was it. Mohan, can you send this to me separately on WhatsApp? Then I'll have a look at it. Okay. And guys, my number is, I'll write it over here. Or maybe you can just note it down. It's 98710 97058. 98710 97058. Okay, I'm in the group, WhatsApp group. So, but yeah, don't write to me. If you want to reach out to me, don't write on the group, write to me directly. That way it will be faster. And allow me a day's time to respond, so if you send today, maybe I will respond by tomorrow. And if it's a weekend, then I'll respond by Monday. So if you send it on Friday, then I'll respond to your message maybe on Monday. Okay, because my weekends are really like chock-a-block because of the sessions. Okay, so yeah, you can write to me. But I think it is too early right now because we are going to cover all these topics and the terms that we discussed in today's class, in detail later. Right? If it still remains unanswered, then of course you can reach out to me. Thank you so much. I'll see you tomorrow morning. Okay. Have a good day. Bye guys. Bye.